Hey, MCE crew, I hope your day is progressing profitably. Today, we're going to go over something that has mystified a lot of investors, especially those that are just getting started. But this is the place to come where we demystify this kind of stuff and get you back on the path to financial independence. So today, we're going to talk about the differences between a mutual fund, an exchange-traded fund, and an indexed fund. Okay? And by the end of this video, we're going to tell you something that may cause you to prefer one of these funds over the others. So make sure you stay tuned until the end of the video. Okay, let's start out with the mutual fund. A mutual fund is a pool of money that has been brought together by many different investors. And that pool of money is then invested in a broad array of stocks or bonds or both in some cases. Now, if you want to go out there and buy a share of, let's say, Microsoft, then a share of Google, a share of Facebook, a share of Netflix, if you wanted to do that, first of all, that can get pretty expensive pretty quickly, especially considering the share price of some of these companies. But all of the companies we just mentioned are tech companies. So what you could do is you could go look for a tech-oriented mutual fund, and it would have those companies and others in that mutual fund. So depending on what the net asset value is of the fund, and that's simply the share price, you would purchase shares of the mutual fund, and then you would be able to participate in the returns or in the performance of those companies and others. So that's basically what a mutual fund is. Now, a mutual fund is usually actively managed. So that means some smart person from Harvard, Yale, or one of these colleges with a finance degree, he or she's going to come out there and they're going to work at that mutual fund. They're going to make decisions real time about what should be in the fund, what should be sold out of the fund, what they should buy more of or cut back on. That is an ongoing process that involves a human being or group of human beings. And of course, we know these type of people do not come cheap because they have student loans that they need to take care of from fancy schools, and they're very smart people in most cases. So an actively managed fund is going to carry along with it fees, and those fees are going to be passed on, of course, to you. So let's say there's a fund, you went out and you invested in it, and it's got a 1% fee. Let's just make the math easy here. And you've got $10,000 in that fund. Well, you're going to be charged $100 for your participation in that fund, because the fee is 1%. So if you put $10,000 is, what you're really going to have is $9,900 in the fund, because you had to pay that 1% fee. So fees can become expensive. You've got to always look at that, figure out what the fees on the fund are, and that'll help you make a decision about whether or not you're going to want to do that. How much money you're putting in will actually go to that fund. Next on the list, let's look at another type of mutual fund called an index fund. Now, an index fund is a type of mutual fund, but the index fund is based on, yes, you guessed it, an index. So let's take the S&P 500. You've got a lot of index funds that are tracking the S&P 500. They're not actively managed because we already know what is in the S&P 500. It's 500 of the largest companies, most of them in the United States. Some of them are not, but that's what the S&P is. And if the S&P takes someone out of the S&P 500 or puts someone in, that's not something that your index fund is doing. That decision is being made elsewhere by the S&P, for example. So there's no need for active management. So when you take away active management, You also take away a lot of the fees that are associated with the index fund. So that's what an index fund. It's a type of mutual fund, but it's set it and forget it, and it gives you broad exposure to the market. Again, if you invest in an index fund that tracks the S&P 500, then you've got exposure to 500 of the largest companies that are out there, okay? And that is something that you don't have to worry about. When you look at the day's performance of the S&P 500, you pretty much know how your mutual fund or how your index fund performed that day. Okay, next up we have the exchange traded fund, or the ETF. Now, this one has a little nuance in it. The ETF tracks an index like the S&P 500, a sector like the tech sector, or a commodity like gold, wheat, oil. Also, with an ETF, you can actually trade these throughout the day. With a mutual fund or an index fund, you can only trade that once a day. And you have to wait until the price settles at the end of the trading day in order to know exactly what price you will get for the mutual fund or the index fund. With an exchange traded fund, it acts like a stock in that you can trade it during market hours. Now, here's the thing. I don't know if I would be too attracted to that, because when you get into an arrangement like this, where you're tracking an index, for most investors, trading that throughout the day is not going to be something that is profitable or practical. Now, there may be larger investors or more investors that can get in on some of the arbitrage going on throughout the day, but most investors are not going to benefit from that nuance with the exchange traded fund. So I asked you to hang on until we finish this video, because I wanted to share with you something that is inherent in the mutual fund and in the index fund that the ETF does not have. And that's a systematic investment plan, or a regularly scheduled withdrawal from an account that you have, where you have money in it, that can go toward purchasing more shares of the mutual fund or the indexed fund. So that's pretty convenient when you're trying to, maybe do some dollar cost averaging, or you're trying to become more disciplined and make sure that you pay yourself first. This might be a way to do that. So this acts kind of in the same way if you have a 401k at your job. You know how they take that money out on a regular basis, usually every paycheck. Sorry, got a call. But you know how they take that money out at every paycheck? Well, that's the same way this works with the systematic investment plan on the mutual fund or the index fund. So that could help you tremendously. So in my opinion, I'll offer you my opinion. You've got some information here. You've got enough to start going and looking at the fee structures on actively managed funds. You can look at the performance of the index funds and what they track. Same thing with the ETF. My personal preference out of those three would be the index fund. And the reason for that is because the index fund is not actively managed. So we've got a smaller or a less expensive fee structure. And then we also have the opportunity to do the systematic investment plan while getting broad market exposure and not having all my eggs in one basket. So to me, the best of all of the worlds is found in the index fund. All right, guys, so I hope that you got a lot out of this. Take a look at some mutual funds if you're thinking about getting in on investing. Take a look at some index funds, some ETF funds. And I can tell you, Warren Buffett recently said that that's one of the ways that he would do it these days. If he was starting out again, he would take a look at index funds, and he believes that so goes the market, so goes your index fund. That's true. And so over time, you could potentially make a lot of money. These are perfect for people who don't want to be in there researching specific stocks. Now, I'm not saying that you don't have to do any research. Of course you do. And mutual funds offer prospectus to help you do that. So, and there's a lot of information out there on the internet about the fund managers and their performance and all of that. So go to it, invest wisely, and guys, I will talk to you soon.